A large property loss can be one of the worst days of a person's life. But if after that big fire or water damage loss, you realize that you don't have the insurance coverage you need to fix your home, your day goes from bad to worse. Unfortunately, it's not until that moment many condominium owners come to realize the master policy their homeowners association purchased is not enough. Individuals need to purchase their own policy, an individual unit owner policy, or HO6.
Many associations now opt for high deductibles and in some cases a more narrow scope of coverage on the master policy. Both are important risk management steps the board has the authority to take, and that makes it even more important that individual unit owners maintain their own coverage. Despite the fact that most governing documents encourage individual unit owners to maintain individual coverage, that admonition seems to be routinely ignored, probably because very few people actually even attempt to read their CC&Rs. And those that do are often never sane again. Surveys indicate that on average, 1 out of every 4 individual unit owners does not maintain their own personal coverage.
As condominiums get older, so do their building components, including the pipes. In fact, the most common property loss we see is water damage. And the more the master policy covers inside the units, the more expensive the claim will be. As a result, some associations choose to maintain higher deductibles and adopt a bare walls approach by scaling back on coverage for wall coverings, floor coverings, built-in cabinets and appliances. With this shift, the responsibility for some fairly large losses can fall solely on the unit owner's shoulders. Now, before you start thinking that this is just a case of the board wanting to dodge its responsibility, think again.
It's been our experience that 60% of the claims submitted under a master policy are due to unit owner negligence, defined as either a loss within the interior of the unit that was due to the unit owner's carelessness, such as a grease fire in the kitchen, leaving a candle burning, not turning off the water before you decide to do your own plumbing repairs. Or it could be a loss due to the failure of a building element or component the owner is obligated to maintain per the CC&Rs. This could include things like the water supply lines to the ice maker, dishwasher, washing machine, tubs, sinks, and toilets.
Believe it or not, those components need to be inspected and replaced periodically. But very few people are aware of that, and even fewer actually do it. If those supply lines fail, and they do, it's going to be an expensive loss. So it might be in the board's best interest to limit the association's exposure by shifting more responsibility to the unit owner that decided to become a plumber overnight.
Remember also that even if the master policy is walls in and picks up most of the damage, the board could still come back to the owner for reimbursement of the master policy deductible. If that deductible is $10,000, that's a lot to reimburse, and an HO6 policy would help. Unfortunately, not all of the carriers that write HO6 policies do a good job of addressing the master policy deductible, so you must exercise caution. Ask your agent, broker, if your existing coverage will cover the master policy deductible when it becomes your responsibility. If the answer is no, you might want to keep looking.
Understanding how the master policy coordinates with the owner's HO6 policy can be difficult. The industry refers to the synchronization between the two policies as dovetailing. It rolls off the tongue better than policy puzzle piecing. But frankly, at times it can feel like a tug-of-war. Ideally, the association's master policy will include language indicating that it is primary. Conversely, the owner's policy should be secondary to any collectible master policy coverage. These simple words, if present, should largely eliminate any duplicates or gaps.
While the scope of the building definition on the master policy can vary from carrier to carrier, in most cases the master policy provides coverage for the common areas as defined by the CC&Rs. These could include common garage areas, lobbies, private streets, curbs, and recreational amenities such as the swimming pool and spa. In addition, the master policy also provides coverage for certain portions of the building or buildings containing the dwellings, that is up to a certain stopping point.
A stopping point. That's where the unit owner's HO6 takes over. There are at least 5 items that are not provided by the association's policy that need to be maintained by the individual unit owner. You should be looking for the big 5 when you're thinking about personal lines coverage. The first of the big 5 coverages for individual unit owners to purchase is personal property or contents coverage. This coverage provides protection for personal belongings within an individual unit owner's home, such as electronics, clothing, and furniture. Depending on how serious the loss is, the County Department of Building and Safety may not even allow you the opportunity to rescue what is left of your belongings. So it's important to make sure you have sufficient protection and take time to document the interior of your unit with a smartphone or a camera. Then send it to a friend or a family member for safekeeping. Such documentation will be invaluable should there be a loss.
The second of these 5 coverages is premises liability, sometimes referred to as personal liability coverage. This portion of the policy provides payments for bodily injury or property damage for which you, as an individual unit owner, may be legally responsible. When Aunt Ida comes to visit you, then slips and falls on the rug inside your unit, breaking her hip, you better believe she's coming after you. Because of the nature of condominium associations, with close proximity to neighboring structures and in many cases shared walls, most insurance experts agree that individual unit owners probably have a greater exposure than owners of single-family homes. And if you have a fire or water loss emanating from your unit to your neighbors, the resulting damage almost always impacts those around you. You may not be your brother's keeper, but you could end up being his cash cow.
Even if you have a good relationship with your neighbors, their insurance carrier may nonetheless hold you responsible for the damage to your neighbor's unit and/or their pain and suffering. And if they can pass their expenses on to you, you better believe they're going to try. For that reason, and many others, we recommend you maintain a personal liability umbrella policy in an amount of $1 million or more.
Now, what if the fire or water loss is so severe you have to live elsewhere for 8 to 12 months? Loss of use protection, also described as additional living expense coverage, pays for necessary additional living expenses such as restaurants, hotels, laundry, etc., should your condominium unit be rendered uninhabitable because of damage from an insured peril. Even if you are an absentee owner and rent your unit out, you may still be dependent on monthly income to help maintain your individual lifestyle or help you make a mortgage payment. In this event, the loss of use coverage should instead be loss of rents protection to help bridge the gap until your unit can be restored to rentable, marketable conditions.
The fourth coverage is often highly misunderstood. It's called loss assessment coverage, and it covers protection against an individual unit owner's portion of a special assessment levied by the Condominium Association Board against all members, but only for a loss that occurred as a result of an insured peril. If the board suddenly decides to special assess you because they want to install a brand new jacuzzi, that's not going to be covered. A wrongful death claim, such as a pool drowning, is an example of a loss where a jury might award a judgment in excess of the limits maintained by the association. A special assessment may be the only alternative for a board to address that shortfall.
Real property coverage is designed to pick up coverage for those portions of the premises not insured by the master policy, and, in some cases, even the master policy deductible that we mentioned earlier. This could include such things as built-in cabinets, built-in appliances. Depending on the scope of the master policy, this coverage could be extremely important. For example, if the association's master policy is written on a bare walls basis, a unit owner would likely need $40,000 to $70,000 or more of real property coverage to address the costs of replacing built-in cabinets, appliances, plumbing and electrical fixtures.
Our firm only writes master policy coverage. We don't write individual HO6s in a community we insure to avoid a potential conflict of interest at the time of loss. Because of this, we're a unique resource. We can be objective in helping you review options offered by your agent or broker and make recommendations that are truly in your best interest.